Welcome to our presentation, The Cost of Capital, How to Calculate the Weighted Average Cost of Capital, or WACC. Our presentation is divided into 5 parts, 5 separate videos. In Part 1, we explore the equity cost of capital components. Part 2 is the equity risk premium, and we explore the equity risk premium puzzle. In Part 3, we look at the size and firm risk premiums. Part 4 is the equity cost of capital, and in Part 5, we examine the debt cost of capital and WACC. Dr. Stan Feldman, the Chief Valuation Officer for Axiom Valuation, will lead us in this presentation.
My name is Stan Feldman. I'm Chief Valuation Officer of Axiom Valuation Solutions, a global financial service firm that specializes in the valuation of private firms. The securities issued by these private firms, which include common equity, preferred equity, fixed income instruments of all sorts. In addition, we value derivatives issued by these firms for a variety of different reasons, like the issuance of employee stock options, for an example, as well as intellectual property. Now, if you all had an opportunity to look at an earlier video on the relationship between public company multiples, the adjustments you have to make to those, and to use these adjusted public company multiples to value private firms, one of the takeaways from that presentation was the dependence of the multiple on the firm's cost of capital. So today I'd like to follow up on that presentation and talk about the cost of capital, and particularly how it's constructed or estimated, if you will. Today's presentation is focused on the elements of the cost of capital first, which is the equity component and the debt component. And when the two emerge together, we call that the weighted average cost of capital. Now, this is the first part of a presentation. There'll be other parts following, which will focus on the calculation of the cost of capital, what the elements are, how we actually calculate it, what the elements of, for example, the equity cost of capital happen to be, and of course, how to measure the debt cost. Well, let's discuss the construction of the equity cost of capital, which is one of the components of what I'll call the overall cost of capital. First, what does the cost of capital actually measure? Well, the cost of capital measures the return investors require, or informed investors require, for accepting the risk of making an investment, whether that's investment in common stock or preferred stock, but generally it's a risk assessment and the rate of return they would require. Now, there are multiple theories associated with the development of the equity cost of capital, but the foundation, I would say, in terms of the private firm community and the general acceptance, is what it's termed a multi-factor capital asset pricing model. Now, the capital asset pricing model was developed many years ago, and over time it's become more formally developed, tested repeatedly, without getting into the nuances of the tests and whether they're relevant or not, or whether the results, I should say, are relevant or not. The bottom line is that it appears as if market participants, both in the public market and in the private market, use some form of the capital asset pricing model. I refer to, in this particular instance, and in the private firm context, the equity cost of capital is made up of a series of components. The first is the risk-free rate, which is usually the 10-year or 20-year treasury rate. This is the riskless return. This is the rate of return that an informed investor would require for taking no risk, essentially. The other components are the equity risk premium, which we'll define in a moment, or call the market risk premium, There's a size premium, namely there's an additional return investors require if the firm is smaller as opposed to it being larger. And there's something called the firm-specific risk premium. Now, if we add these components up, that is the treasury rate, the market risk premium, the firm-specific premium, and the size premium, we just add those components together, that gives us the equity cost of capital. Now, keep in mind that the equity cost of capital is not fixed forever. It changes over time. And the equity cost of capital that we use in valuation is calculated as of a given valuation date.
To continue this presentation, please see Part 2 of this video series, the Equity Risk Premium and the Equity Risk Premium Puzzle.